Hello, everybody. We're here in December and 2025, and I'm not going to act as surprised as I always do every month, all right? Although I just had to say
Last month of the year.
Yeah,
Here we go.
and I do have some bad news to break to you, Jeff. I had a special guest lined up to drop by today, but he got double booked.
Oh.
So you're going to have to play Santa yourself here in the office. All right. So I know there was quite a bit of feedback on your pilgrim hat last week or last month,
yes,
and
yes,
I think that's going to make the rounds, especially during the client event. We're going to have it up on the screen.
All right.
So-
It looks good.
So you did mention we got a little bit to cover here today.
Yeah.
So we'll get going and jump right into it. Of course, this is my job. Just want to make sure everybody knows how to get a hold of us, and that we cannot receive any text calls or chats at this time while we record this. Contact information is dkautz@kautzbuckley.com and jbuckley@kautzbuckley.com. The office number here is 716-276-8480, and the ever-popular text number 716-272-1129. I just want to take a breath here and say, remember, clients, please contact us via text on this line, not our personal lines, please. Clients have been very good about it, but
Yes.
on occasion we'll have friends that will talk about something and slide into a business conversation. That's something that's very important, that we must be on compliance-approved lines.
Right.
So any texting, please get us at the 716-272-1129. Now that I've done my disclaimer, and of course, follow us on Facebook, LinkedIn. We've been getting a lot of traction on that, Jeff, haven't
Yeah,
we?
we have, right? We're trying to get some
Yep.
more of this out.
Yeah, we're out into a whole new realm of people that we need to talk to. Listen, I'll shut up and let you
That's it.
get going, because I know we
Yeah.
got quite a bit to cover.
Well, this, again, start with that look in the rearview mirror, and this is just how things wrapped up through the end of November. We had some more volatility. Again, November was kind of a surprisingly volatile month, but revealed some strength in equities, meaning, again, that market breadth that Dan and I have talked about, where we're starting to see people diversifying away from those magnificent 7 tech stocks and investing in other stocks that are attractive when you look at valuations and earnings. So we're starting to see that spread out a little bit, probably exemplified by the S&P, Standard & Poor's Mid-Cap 400. So these are not the largest companies. These are your mid-sized companies, but that was one of the strongest performers during the month of November. So again, people looking for opportunities outside of those high-tech, high-growth, magnificent seven stocks there. So we did see, actually, the Magnificent Seven tended to bring up the rear a little bit because they did have that volatile month and money's flowing out. So we had that, but some sector rotation, healthcare, regional banks, home builders, other areas that probably will continue to really perform well as we move through the end of this year and into 2026. And we're going to talk about that a little bit, but just some areas to watch. So yeah, and then this again just kind of focuses on the individual sectors. Surprisingly so, healthcare did lead the pack in November. Again, with that broadening out trade, a lot of healthcare companies had really been one of the worst performers up until probably about October, November of this year, if we go back about a 12-month period of time.
That's why I'm chuckling, and we made that comment earlier. Healthcare was more in the basement and has rotated up.
It has.
So carry on. Like I said, we got a lot to cover.
No, it's right. That's right. That's an interesting sign. There's a lot going on in the healthcare sector. Some uncertainty as we began the year with President Trump's term and how things at the FDA and the CDC and everything would be handled. We're starting to get some clarity on that. So I think, again, people moving out of the Magnificent 7 tech stocks, they're starting to look for other opportunities, and they're seeing that a lot of these healthcare companies do very well, and they're a little bit undervalued because people had shied away from them. So that's why they were able to kind of accelerate through November. And again, now this kind of looking out the windshield here, this is where we are currently, at least as of through December 8th. And this is a more realistic picture of how you as our clients are set up with your portfolios. None of our clients are 100% in stock, so looking at the S&P 500 isn't going to give you an exact picture of how your portfolio is performing, because you're going to have some other investments in there, some more conservative fixed income or bond investments, that kind of thing. So we put this chart in there to kind of give you an idea that now this is going to be the most aggressive, an 80% equities, 20% fixed income. And you can see how that's performed as compared to different allocations, going all the way down to the bottom of the chart there. Someone that the most conservative investors we work with might be somewhere around a 20% equity exposure or stock exposure and about 80% in fixed income. So it gives you an idea of the disparity between the performances. And obviously the growth has been coming in the stock area there. But the one thing that I noticed here too, because we're as of December 8th, we're looking almost at a 12-month return, going back for the beginning of the year. But what we're seeing here is, if you recall, we had the election, there was a rally in the markets, and then right before President Trump was sworn in, so that's included in this 12-month return, we did see the markets go down and then accelerate back up again. So when you're looking at your time periods, make sure you think back and what occurred during that, that 12-month period or those 3-year periods, because 3 years we're going back now and we're starting to see better performance in these overall charts, because 3 years doesn't take us necessarily back to 2022, which is a very difficult year. So
you got your 5-year, which does, you can see
Yes.
a difference between
Drastic
the top
difference,
line.
really.
And the one thing I wanted to point out too is, I know we're coming close to the end of the year, and we're looking at an 80-20 versus a 70-30. 80% equities, 20% fixed income versus 70% equities, 30% fixed income. That rate of return is how far apart? Well, point and some change.
Yeah.
What's the risk that you're taking? Right? What step of risk did you take to realize that 1 or 1.5 or 1.3% return? And that's when it comes to risk-weighted returns that Jeff and I talk about. Is it worth taking that one step out of risk to get the rate of return you're looking to get? And that's something we review, and that's everything we talk about. But look how tight they're getting, 14 to 12 to 12, and your allocation. So it's important to look at how much risk you're taking in order to get those rates of return. That's what struck me when you go out 12 months, how tight those returns have gone.
Right.
So
yeah.
Speedometers.
Yes.
Looking pretty good. Look at the bottom right corner. I got to remember I'm sitting on this side of the TV. Look at that. That's been red for how long? And it finally popped yellow. Yep. We'll see for how long.
And a significant change, too, if you're able to look at that. I mean, the gray needle kind of shows where we were and where that's changed just in 1 month's period of time. So if you think about the developments internationally, that's moved into a much more neutral concern and again, just to sum this up, this is the Rockdale speedometers. This is looking out 6 to 9 months. So we're trying to see a little bit into the future, but they see geopolitical risk as being much less significant than it was even just a month ago. We actually have 6 green speedometers on the screen too, which I think is the most we've had in some time. And we've got a number of areas, like the U.S. Economic Outlook, we've ticked a little bit higher. Consumer sentiment has ticked a little bit more positive.
Corporate profits.
There's a number of movements. Now, the labor market has ticked down a little bit, and that's something that we're constantly watching because, again, to support our strong economy, people need to have jobs and be earning incomes. And if there's a problem there, if we start to see layoffs accelerate or if the unemployment rate ticks up, that's an issue. But again, we would have the Federal Reserve trying to modify interest rates to address that as well. So a good view looking down the road.
It's positive. We've been in neutral for so long.
Yes.
And this has been a little light at the end of the tunnel. Let's see how it pans out.
Right.
So
and the next slide, what I wanted to try to bring together here too is that this time of year is when everybody comes out with their outlooks for 2026. And when I say everybody, I mean all the big banks, JP Morgan, Wells Fargo, the big brokerages, Fidelity, the mutual fund companies, American funds, they all put together what they think that they're expecting to be. And I read through, and Dan reads through as many of these as we can tried to give a consensus view, and I actually did even find an article in Yahoo Finance, which doesn't always do the deepest dive in certain things, but they're good at consolidating information from a number of different points. And this is kind of what they pointed out. I know there's a lot of words on the slide here, but really I think the things to take away that this is like a consensus of the estimates that are coming out there from many, many different sources. Revenue should benefit from economic tailwinds. We're not expecting a spectacular economic growth, but we are definitely expecting growth. And there's thoughts that this One Big Beautiful Bill Act, that some of the changes it made to the tax code will result in larger tax refunds this year, and that there's also some easier monetary policy coming, as the Federal Reserve, if they continue to cut rates, that kind of thing. So overall, the consensus is that we're still in a pretty good spot right now, and there's hopefully a number of tailwinds that'll help continue this economy moving forward. Some economic challenges. We're still dealing with some persistent inflation. There's still concern that we really haven't recognized the full impact of these tariffs yet, and that may be coming, and that may lead to increased inflation. And again, that's going to put the Fed in a tough spot to try to get that down to their 2% target rate. But again, it doesn't seem to be a significant problem, at least at this point, in the sense that inflation is being persistent and sticky, but it's not accelerating. So at least now. Profit margins are expected to get fatter. Companies are continuing to report earnings, and the projections, as the analysts look forward into 2026, they're expecting those earnings expectations to continue to move up. So companies are in strong positions, and as long as that continues, that benefits the stock market.
That's really something we watch. We watch our earnings
Yes.
reports. We watch the job market's important, but the earnings really drive our decisions.
They do. They drive stock prices, really, is what people are willing to pay for. And then, earnings growth should be strong, as we've kind of touched on. The consensus calls for an impressive 14% earnings growth in 2026. Now, a lot of that is top-heavy. That's factoring in those Magnificent Seven stocks, as they note here. But even again, the companies where people are starting to find value, they're looking beyond that Magnificent Seven. And that's what the money managers that we work with, they're diversifying, they're spreading out, they're taking advantage of this as well for our portfolios.
To make that point, do you mind if I jump back to that,
go back.
to a couple slides back, where we seek the equal weights? Remember we talked about this before, that it's not just the Magnificent Seven right here. Equal weights is if we gave the same weight to every stock in the S&P 500.
Yes.
And this shows the breadth. This
Right.
shows that the earnings are not, yes, they're top heavy, but we're beginning to see other firms also benefit.
Definitely.
So
Yes.
that's a good sign. Good here?
Yep, that's it. So
All right.
next, what Dan and I wanted to do here, because we are in December, we wanted to touch on two things that we see as pretty significant changes coming with the beginning of the new year. And we want you to start thinking about these things and start getting ready. The first one, and this would really apply, I tried to narrow this down because this is not going to apply to everyone, all right, that's watching this video. However, I'd like you to keep this in mind. This and the next thing we're going to talk about, it may not pertain to you specifically. In this case, this is a 401k catch-up rule, and you may say, look, I'm already retired. But you might have relatives, children that are still working and still contributing to their 401k. So this is information that even if it doesn't apply to you directly, it's worth the time to pass this on to others that may still be affected. If you're 50 or older and you're earning over $145,000 a year and you're taking advantage of the opportunity to reduce your taxable income and boost your retirement savings by making what are referred to as catch-up contributions to your 401k, it's significant to know that starting in January, all catch-up contributions will be required to be made to a Roth, which is an after-tax on an after-tax basis in your 401k. Now, what does that mean? Well, if you're making your full contribution that the law allows you to do, that it continues to go into what's basically the equivalent of a traditional IRA into your 401k. So you get to deduct that from your income tax,
So
basically.
that's before tax
Yes,
contribution.
exactly. Before tax contributions. Whereas if you make that additional catch-up contribution, 7,500, it can even be higher than that if you're in your 60s. If you make that, all of a sudden, you used to be able to make that as a before-tax contribution as well and further reduce your tax liability. No longer. Starting in January 1st, this 7,500 or even your additional catch-up contribution, it's now going to be taxed. So if you were counting on that tax, the bottom line is you're going to be paying more in taxes in 2026. If you were counting on that tax, kind of that pre-tax contribution to reduce your overall tax benefit, you're not going to get it any longer.
Now, I just want to be very clear too. This is the qualifying person.
Yes.
It's not every contribution
true.
or every catch-up. You have to be 50 over 145,000 of income and making those catch-ups.
Yes.
So it may be a little confusing, but you got to make sure you fall into that bucket. If you fall into that bucket, then you have this issue. And it's a real big issue. At least you're saving something towards retirement.
Yes.
But it's after-tax dollars. It'll be treated as a Roth once you leave because it will be considered a Roth catch-up inside your plan. Now, who's responsible for identifying this and making this happen? It would be the third-party administrator, referred to as a TPA, the people who are in charge of your 401ks. We talked to quite a few of them, and some of them are scrambling to make sure that this gets into their system. In other words, they can slice and dice everybody they do 401ks for and say, oh, John Smith, oh, that was the Pilgrim for last month. Yeah, John Smith qualifies, makes over 145,000. And he's doing the catch-up, therefore it must be a Roth. So I don't think this falls on the individual. It really falls on the third-party administrator.
It does, but what I will say, though, is a lot of 401ks didn't include a 401k or a Roth, component already. So what was happening is that the plans themselves had to be modified to accommodate this. And then some of those plans were saying, well, look, we're going to force you as the participant, you as the employee that's making these contributions, to elect where you want that money to go. Yeah, and it becomes difficult because if you start to elect on day one that you want some of your contribution to go into that Roth component because you're thinking, well, over the next 12 months, I'm going to be contributing, I'm going to use those catch-up contributions. But if you start in January putting that money in, you haven't even hit your maximum
You're saying if the person actually picked the post-tax and pre-tax choice.
Yes, yeah.
Right, I'm talking about somebody who's always been putting into their traditional 401k pre-tax dollars, and then they do fall into this pot.
Yeah.
The TPA should pick up.
Well, but
Yeah,
but what I'm saying is I've talked to a number of people that where their 401k provider is coming to them and they're saying you have to make an election on January 1st as to where you want your catch-up contributions to go, right?
No, this is so problematic.
It is problematic, and I think we're going to touch on this, and the next thing we're going to talk about. Both of these things are still a little bit in flux.
Yeah,
they're results of this one big beautiful bill.
Yeah,
so.
there is a lot of this is the rule.
Let's figure out how to implement it down the road.
And this is a great example of one of them. These are called the Trump accounts. This is, I think, a pretty powerful tool. Jeff, this is why we wanted to leave time, so I'll be quiet. Go.
Yeah. Well, no, this again, another component of the One Big Beautiful Bill Act created a new tax advantage savings and investment account for children called the Trump account. Now, again, you may be saying, well, I don't necessarily have any children or I don't have grandchildren or whatever it might be, so this doesn't really apply to me. I disagree. I think this is something that everybody, regardless of what phase of life that you're in right now, you need to be aware of these because these accounts are an option even for estate planning. These are options for, they can be contributed to by anybody, by an employer. This could be a new employer benefit offered to employees. Well, they'll throw some money into a Trump account for an employee's children. So this is a very interesting an account, but I want to point out a couple things too. First off, let's talk about what the account does. They're initially eligible for after-tax contributions. So these are not pre-tax, they're not retirement savings accounts. They're after-tax contributions, but you can do up to $5,000 a year until the beneficiary reaches age 18, all right? Now, with an IRA, the earnings then grow tax-free. So if you initially put in $5,000 and over the next several years it grows, you don't owe taxes each year on that growth. It's allowed to grow tax-free. That's powerful, powerful growth over time. Withdrawals are generally prohibited until the beneficiary reaches age 18, but at that point, they need to be converted to an IRA for that individual, for that child, and the IRA withdrawals rules will apply. So there are strings attached, and you can pay penalties if you take it out at that point in time. But it's like a 529 plan, an education savings account. The beneficiary doesn't need to have earned income. So in other words, this $5,000 can start going in to an account for someone that's just born, that 1 year old, 2 years old, whatever. You don't have to have earned income to make a contribution, but nearly anyone can contribute to that account. Again, it can be relatives, it could be friends, it can be employers. I mean, it's a very wide open contribution restriction. There's no requirement that the proceeds be used for educational expenses or any other purpose. So these do differ from your educational savings plan, the 529s. Contributions will generally be made with after-tax dollars, which means there is no tax deduction for the contributions, but any potential appreciation or earnings within the account grow tax-free. So we've set the groundwork now. You've got a pretty powerful account here where you can make contributions and it can grow tax-deferred over time. So jump to the next page here. Now, almost anyone can contribute to these Trump accounts: parents, grandparents, family members, friends, employers, even nonprofits, okay? Unlike other tax advantage retirement accounts, these accounts have no earned income requirement. Just kind of stressing that point because it is different. An IRA account, a traditional IRA or a Roth IRA, you have to earn money first before you can make that contribution. This removes that restriction and gives an opportunity. So you can contribute until the beneficiary of the account turns 18. Maximum amount per year is $5,000, but it is indexed to inflation. So it is going to go up every year. There'll be a little bump in that. Employers can contribute $2,500 to the child of an employee's account, tax-free each year. Again, this is where we get to where we don't have all the answers yet because we're still sorting this out. It appears that employer contributions are included in the overall $5,000 limit. However, we need some guidance from the IRS on this. Local, state, and federal governments, as well as charities, can also contribute tax-free to a child's account, and those don't count to the $5,000 annual limit. So we've already started to see some, Michael Dell, who started Dell Computers, has already announced a $6.25 billion gift
to fund this.
And he's going to start putting $250 or $500 into accounts of children who can open these accounts that are not yet 18 years old. So it's incredible, really. And I think that it's anticipated that there'll be a lot more follow-up to that. Now, this is where it starts. It's not all been fleshed out entirely yet. Trump accounts will become available in 2026. So they're not even yet in existence, but starting with the new year, they're supposed to be. But the first contribution to the account can't be made until after July 4th of 2026. And we're not even sure yet exactly who will open the account or where it will be held. Yes.
Will it be held at a government level? Will it be held at a level like an IRA where an advisor can help you open it up? That is unclear. Who will be the custodian of the money? Unclear, and you did mention here.
Well, this is just a little extra kick because this is something on top of it. If you've got a grandchild or a child that's born between January 1st of 2025 and December 31st, of 2028, there's a federal grant there of $1,000 to help seed these accounts. So it doesn't apply to everybody, but keep that in mind. It's an important point. Now, the next step, I thought I would kind of try to sum this up. You can go to the next slide there.
Thank you.
Yeah. Well, I just thought how this, maybe to try to illustrate how valuable these accounts could potentially be over the course of a child's lifetime, okay? Some families may choose to use Trump accounts as part of their estate planning strategy, okay? So we're not talking, this is this can apply to entire families, the way estate planning is handled, the way wealth is passed on to the next generation. Accounts could give parents or grandparents a place to transfer wealth from their taxable estate while giving the child a huge boost in retirement savings. So let's look at what that really means, okay? This is an example. A family, let's say a family is financially able to contribute to and invest the full $5,000 in a Trump account for the entire 18 years. A newborn child, a grandchild, child, whatever it might be. Yeah, adjusted, we're going to adjust that.
Increases.
Yes, and it does increase about a 2.3% inflation rate per year. So this is going to go up every year, the 5,000. Assuming a reasonable growth rate of 6%, by age 18, that child's account would hold around 191,000 in assets. 191,000, that's a good start there. It's about 108 of that is after-tax contributions, and then about 83,000 in investment gains. So that's powerful. Now that child hits age 18. At that point, the beneficiary can convert it, the child, yes, can convert the account to a traditional IRA. And then it can continue to accumulate potential gains on a tax-free basis. Now, let's say the kid's just getting started. It's now his IRA or her IRA. They don't have the ability right away to make those $5,000 contributions. They just got started working, or maybe they're working at work and they've got the 401k, so they're contributing to that. We can, even if the beneficiary made no additional contributions to the account, by the time they reach age 60, we're not talking 73 or yeah, age 60, the account could be worth more than $2.2 million.
The possibilities of this are huge. And I know we're running very late on time here, but the other thing too is that when you think about estate planning, I'm thinking about clients that have non-qualified accounts. Let's just say they might have NVIDIA that has a huge gain in it.
Yes.
Right? That's what you could do, an in-kind transfer from that account to this. And all of a sudden you bring your taxable estate or your taxes down.
Well, I think you're still going to be limited to the
5,000.
Yeah, to the 5,000,
but
you
at
can
least
get,
it's 5,000 of gain out of the taxable estate of mom, dad.
That's right.
So this is, the groundwork is here because this walks and smells a little bit like a non-deductible IRA, right? But there's a few more bells and whistles to it. So there's some questions to be asked, but boy, it's huge. I want to thank everybody for joining us, and I want to wish everybody a happy holidays and happy new year. It's been a great year for us, and we want to thank every one of you for giving your trust to us. So on that note, we want to say goodbye. Next time we'll see is 2026.
Thank you.